There are about 600 people across BlackRock that are working on sustainability. My role is that I am the head of ESG investing in the active fixed income group. ESG was not even on my radar when I came to BlackRock. When you are an options trader, it introduces this unhealthy level of paranoia about everything because you're always thinking, what did I miss? Is there information out there that's not priced into the market? And I began to think that climate risk, just looking around the asset manager community, was something that was not really being paid much attention to. We are at this point swimming in ESG data. There is so much ESG data coming at us that we have thousands of different key performance indicators. Some are using this data set, others are using that data set. Portfolio managers are asking, I see all these ESG KPIs, but what am I looking at? And this is a conversation that we hear globally. I hope one day someone will do a case study on the birth of the green bond market because it's really fascinating. A document was produced called the Green Bond Principles, and it laid out the 4 things that you should have if you're going to issue a green bond. Zurich Insurance gave us a $1 billion bond mandate to buy green bonds. We were willing to lean into this theme. Zurich was willing to lean into this thing. And what has emerged from this is nothing less than remarkable.
Hello, Ashley Schulten. Thanks for coming on the show.
Well, thank you for having me, Scott.
Today's going to be all about ESG and sustainable fixed income, publicly traded securities investing at BlackRock. But before we get into the weeds, I always start at the beginning. I think your story starts somewhere in Florida, in the US of A. You're a Florida girl.
I am. I grew up in South Florida, in Sarasota, on the Gulf Coast.
And then you went to high school at Cardinal Mooney High School in the Sarasota Manatee area. Tell me about that.
I did. It was a Catholic high school, private high school, wonderful teachers, wonderful friends. Still are in touch with, several people that I grew up with and went to school there with.
And then from there on to Vanderbilt University in Tennessee. What was behind your decision to go there?
I wanted to stay geographically close to family. I wanted to get out of Florida. My family is from the American South, I would say, Alabama and Kentucky. And so I had relatives in the area, grandparents, etc. And I loved Vanderbilt. It was a wonderful time in Nashville. It's even more of an exciting city now, I think. But it was a really interesting time and place to be in Nashville.
What made it interesting for you?
I think there's a country music scene. It was the first time that I was getting exposure to kids from all over the U.S. So meeting, people from different areas. At the time it was, and still is, but at the time much more very social. People ask me sometimes, was it hard to be a woman bond trader on Wall Street? And I say, no, I went through sorority rush at Vanderbilt. That was much harder. So I had, lots of social activities there, had some great professors, got to be able to meet people from all over the country, but stay in close proximity to my family.
But you studied political science and government. So what was the idea behind that? And did you always know you were going to jump into finance?
I wish I could tell you there was a grand plan there. I didn't know what a bond was when I started working on a trading desk. And I graduated in 92. I needed a job. And I went to go work at First Union in Charlotte in a trading assistant role. And my job was to, get coffee and answer the phone and provide checks on trades that went through, et cetera. And so I think I just got, I would say, lucky to step into something that I then became very passionate about. It was a time in the early 90s when derivatives were really jumping onto the scene. Back then, a swap was considered a derivative. And so it was the beginning of this boom in the derivatives market, and I found it really exciting, and I loved the pace and I loved the people. And so I stuck with it and I guess got good at it and have stayed in this career path ever since.
So in Vanderbilt, you just started to interview with banks?
No, not really, actually. I left Vanderbilt and went to law school briefly back at the University of Miami. And I didn't feel like it was for me. And then I moved to Charlotte without a job, Charlotte, North Carolina. And it was at the time when the banks, in the early 90s, the regional banks were, I would say, expanding into super regionals, if you will, like the Bank of America Nations Bank merger and the Wachovia Wells Fargo, and all that was going on at the time. And so it was an exciting time to be in Charlotte, and banking was the industry there. And so there were hiring opportunities there. That's how I ended up in that role. And, somebody took a chance on me as a trading assistant, and, and then it just kind of fed on itself, right?
So after First Union, you did a series of 4-year stints. So I guess you had some kind of a 4-year itch. And the first one was BNP Paribas.
That was in New York. So when I was at First Union, I was trading U.S. agency debt. And it was at a time when the government GSEs, the government-sponsored enterprise, Fannie, Freddie, Home Loan, were really starting to grow their debt portfolios. And that paper, that issuance, was popular among a lot of First Union clients. And so I was active in that market. And those bonds had embedded options in them, which we call BERM options, Bermudan options. What it meant was that these callable bonds, the issuer could call back from you if interest rates went a certain way. Not to get into that too much, but that's how a lot of these mortgage portfolios were hedged on the other side of the convexity that you get as a mortgage holder. And the bank BNP Paribas, French bank, strong in derivatives, historically, strong in trading BERM options, as a counterparty to these GSEs, was jumping into that business. And there was a woman, Susan Dingillian, who I met, who was working at BNP, again, took a chance on me and invited me to interview at BNP. And Joe Carvalera was running the desk there. They offered me a trading role there to trade Bermudan debt, Bermudan embedded option debt that they were doing the derivative on the back of, and we were trading the bonds as a kind of a complete package. And so, so I picked up and moved to BNP Paribas in New York. It was a very exciting time.
So you made it to the big city.
I think the first time I got to New York was when I was interviewing there. So all these kids come through, they've been spending lots of time here. I think I was, well into my 20s before I'd even been to New York City.
4 years later, you landed at JP Morgan, I presume in New York, as a surprise fixed income trader.
Yes. So I took a little bit of a break. My father was diagnosed with terminal cancer when I was at BNP. And I quit and left and came back to Florida and helped my mom take care of him. And it was a beautiful year, to be able to spend time with him in that way. When I guess that got, wrapped up, it's not the right word, but I went back to New York and started interviewing. And agencies was still a really hot market. And I went to JP Morgan at that time.
Another 4 years there, and then you jumped to Goldman?
Yeah, then I was at JP Morgan, and we were doing a lot of underwriting business, and I got an opportunity to go to Goldman, and I took it. And so I spent a number of years at Goldman, both trading agency debt, but then also the underlying derivatives, the interest rate gamma, on the derivatives desk there.
After another 4 years, you landed at BlackRock, and how did that change come about?
A little bit longer stints at some of these places, but I think you get to be around 40, and I was a line trader, meaning I was making prices for clients. So in the crosshairs, it's not that I didn't love where I was and love the role and the firm. It was just that is a very intense role. And traders age out of some of these roles. So it's basically doing math all day long at a desk with a gun to your head. And so I thought it was after the financial crisis, which I think all of us as traders on the street were worn out. And I thought, what do I want to do with the next 20 years? And BlackRock was first of all, was a client, and I had a lot of contacts there. And obviously, I think when you're thinking about making a switch, wanting to go to what you think is the best buy-side firm. For me, it was sort of an asset allocation decision to move from trading on the sell side to going over to the buy side. So I came over to BlackRock actually to trade fixed income, to trade interest rate derivatives.
Now you're the head of ESG Investment, Global Fixed Income. But before we get into BlackRock, I wanted to mention that you are also an Aspen Institute First Movers Fellow. Is that correct?
That's correct.
And what is that exactly?
It was a wonderful program that the Aspen Institute sponsors. And they select a certain number of individuals that primarily work at organizations that are working on sustainability, all different sectors. And they bring them together for a 1-year intensive program, which includes multiple offsites and networking and programming. Sort of think about how can we best affect important change? How can we think about more collaboration? And so I participated in that and still participate in that. It's a wonderful organization.
You are also on the board of the Mianus River Gorge, the first land conservancy project of Nature Conservancy. That's very specific. So tell me about that and how that came about.
Yeah, so I'm passionate about this small group. It's really, like I said, it's a land preservation group. It's on the outskirts of New York City. It's one of the earliest land preservations group again, and it was the first project that the Nature Conservancy did. It's been around for a long time. And it protects the watershed in a lot of areas around New York. And it does land preservation. It also does education for high school students, et cetera. And so I sit on that board. And it's interesting to me because a lot of the things I work on are very high level, public fixed income, et cetera. And this is very grassroots. And so sometimes you see these things talking to each other, and it gives you an interesting lens on the whole topic around sustainability.
I have seen some pictures that indicate you have some level of involvement in the equestrian world.
Oh dear, yes. You had to describe me in any way. I'm an animal lover. I'm a nature lover. And I do have dogs and a horse. And it is my passion and my hobby. And then what I spend all my free time doing.
All right. So now back to BlackRock. In 2012, you landed at BlackRock and you're responsible for ESG investing in global fixed income. You've been working in ESG, I think, for around 10 years at BlackRock. But you started working, as you mentioned, on the sell side as an options trader. So tell me how this transition from all of your career as essentially a trader into ESG and the fixed income space.
So ESG was not even on my radar when I came to BlackRock. And I don't know if it was on many people's radar at that point. We're talking, ESG is on everyone's, tip of their tongue now, but, back then it was sort of niche. And it was really relegated to really equity governance and thinking about proxy voting, et cetera. And I think that there started to be global conversations about climate change. These COPs that were becoming more and more popular, the Paris Agreement. We started to have some clients ask us about these concepts of carbon footprinting, which is sort of a new, it's old hat now, but it was new at the time. And I think that for me, when you are an options trader, it introduces some, I would say, unhealthy level of paranoia about everything because you're always thinking, what did I miss, right? You're selling volatility or buying volatility. And so you're constantly trading on information and price anomalies that are based on information. And so you're constantly thinking about, is there information out there that's not priced into the market? And I began to think that perhaps climate risk and this topic around climate, just looking around the asset manager community, was something that was not really being paid much attention to. And we didn't really have the tools to do it, even though I knew that there was some science out there and some models that we could potentially tap into. And so for me, it became intellectually interesting to see if there was something we could figure out that would have market pricing on this. And then I think the other thing that became interesting to me was the concept of building out market infrastructure around things like green bonds. Because having spent a lot of time in the GSE market, the Fannie and Freddie debt market, and seeing those asset classes grow and what it took to create scale there, the concept of growing market infrastructure on green bonds became very interesting to me. And so I think while I started on this as an intellectual curiosity, the more and more I learned about it, the more passionate I became about climate change as a general topic and how important mitigation and adaptation is going to be. So I grew more personally passionate about the topic above and beyond just, oh, this is an interesting math problem. Let's see if, we can grow here. So yeah, that's how I sort of got interested. It was a side role for me. It was, I would say, doing it off the side of my desk. It wasn't my primary role. And then it became my primary role after a year or so.
So tell me how this evolution inside of Ashley Schulten evolved, and I presume somehow it started to spill out or spread out. You must have started talking to people about it. Were you the only one talking about it when you started to anticipate that there was risk that may not be priced in the market?
There were definitely some early, I don't want to take any credit for that. I'm a latecomer to this in terms of the thinking about carbon as a risk. There were lots of academic research published on this, and certainly there were some of our clients that were well ahead of thinking about this, especially in sort of the Scandinavian region. I think in talking to some of our clients around this, there were a handful of people around the firm that were working on it in different asset classes as well. And I think we just were paying attention to the pulse of the market and this starting to pick up. And so it did start to snowball in terms of interest internally. And now there's lots of teams within BlackRock and other asset managers and asset owners that are focused solely on sustainability. We just happen to be, I think, looking at it at that early time.
You made it sound like not too many people around you, at least in fixed income, were necessarily thinking about it. You started this on the side, like a side project. So was this something like you'd be out at lunch and started talking to somebody else about it?
A little bit. I think, there were other people that were interested and involved, and a lot of it was in collaboration with clients who were also asking us these questions, right? And so while there were sustainability functions within the firm, there were not any that were specific to fixed income at that time. And so we were really partnering with some of the other teams at the firm, BlackRock Investment Stewardship Team, which, still is a big part of our sustainability effort. A handful of individuals there were really focused on, how do we start to think about these topics for different asset classes. And, there's been so much of an improvement in the ESG rating offerings that we see now. But I can remember, thinking about, okay, let's onboard MSCI data and some of these ESG ratings. And then what if we could get these in Aladdin? That could be really powerful. And so those early efforts about ESG data mapping, that data used to come in Excel spreadsheets, and now it comes through API pipes and goes directly into Aladdin, maps to CUSIPs. And so that was really, an exciting time to try to think about what was possible.
You mentioned Aladdin. Can you just explain briefly what Aladdin is to listeners who might not be familiar?
Yeah, Aladdin is, I would say, the best way to describe it is it's our neural network at BlackRock. And it is a way that we view all of our holdings and risk and characteristics of the assets that we manage that speaks to different groups, speaks to the central nervous system of the way that we manage risk. And it's not only a BlackRock product. Aladdin is a product that other investors in the market use as well. And so while it's a BlackRock product, BlackRock, investors use it, but it's also sold externally. And so it's a way to keep tabs of your portfolio and, your holdings, your trades, all of that.
You said that you started thinking about this risk, and then I think you said 1 year later, this became your job. That's a big transition, because I guess that means you moved off the desk.
Yeah, I stayed in fixed income, and it became important to clients to focus more and more on it, and it was happening in the market, right? And so we were getting more data sets. We were getting more requests from clients to understand, what our views are on ESG were, and how are we going to manage some of these new risks and opportunities that were presenting themselves. And so it became my full-time role at that point. And we started to dive into concepts around scenario analysis and thinking about what forward-looking climate models could show us about risk in portfolios, and thinking about methodologies to carbon footprint fixed income portfolios. How do you think about fixed income versus equities? What are the methodologies for this? And so it took off around that. And I think at the same time, other asset managers were seeing the same requests from clients coming in.
I want to focus our discussion on ESG fixed income investing at BlackRock. Can you give a very high level overview of BlackRock and then give a high level overview of its dedicated sustainable strategies, and then drill down on your current role and responsibilities and the number of fixed income funds with SRI ESG strategies and how sustainable and ESG fixed income investing fits in overall at BlackRock?
So BlackRock is an asset manager. I think it's important to state that we are not an asset owner, and there's a difference between that. It's not our money. We are contracted by our clients to manage their money for them. And so, as you mentioned earlier, we are the world's largest asset manager, and we invest across all asset classes. So we are an indexed product provider. We are an active product provider. We have cash funds. We have alts funds. We run across the gamut. And we're global. And so we have offices across the globe. And within that, in the sustainable investing, I think we manage close to 700 billion in sustainable type mandates. We have around 450 products that are sustainable / ESG tilted. There are about 600 people across BlackRock that are working on sustainability in one form or another. My role is that I am the head of ESG investing in the active fixed income group. So I have 8 people on my team. And so we work across all of our different fixed income investment teams, whether that's the emerging markets team, the high yield team, the investment grade team. We work with our municipal team, our sovereign teams, our securitized teams, et cetera. And so alongside with me, it's sort of a hub and spoke model. We have teams that work in equities. We have teams that work in the infrastructure group. We have teams that work in the private credit group, et cetera. And at the center of the organization, there are resources for us that are focused on sustainability broadly. And so whether that's a group of climatologists that work on climate modeling in our Aladdin systems, whether that's other research groups that help us think about the risk reward of some of these ESG metrics, those are shared resources. And then finally, we have, I think, a 50-person team in our BlackRock Investment Stewardship Group that helps us focus on engagement with the holdings that we have. Oftentimes, this is around sustainability topics, can be around governance topics, but this group works on behalf of all investors, and we partner with them to have conversations with companies about some of these emerging issues.
So your remit and your team spans across the company, across a number of funds, but there are a few funds that you are identified as a portfolio manager on. Is that correct? And which funds are those?
So I help manage a number of ESG fixed income funds. And when I say that I help manage them, what I do is I provide the ESG methodology. And so what I'll do is I'll partner with the traditional portfolio management team that's the expert in thinking about what do we think about the shape of the yield curve, what do we think about the Fed, what do we think about currencies, and partner with them of what is our active sustainability methodology going to be on this fund. So we'll create the I guess if you call it rules up front around what's allowed, what kind of ESG goals are we going to have on the portfolio. And then for names that we need to have an active sustainability view on with my team, we'll have active conversations with lots of these companies, go under the hood, look for things that we don't get from the data sets, and try to make determinations of whether these are appropriate holdings for an ESG fund or not.
And what determines whether you're assigned as a portfolio manager to a fund? I think I've found 5 funds that you're identified on, but you obviously have a lot more funds at BlackRock than that.
A lot of the methodologies that we create for these funds are used across the platform. And we do have an overriding methodology called PEXT, which is our framework, our broad framework that we use across the portfolios. I still do participate in a lot of the sustainability conversations on some of the funds that I am not a named portfolio manager on. It's just that some of those were new funds that we launched originally as ESG funds, and there was a decision to put a specialized ESG portfolio manager on them.
What is your theory of change for SRI, ESG, fixed income investing? What is the role of publicly traded bonds in driving the sustainability agenda for the long-term benefits of clients and ultimately for society?
So I'd like to take a second to talk about a concept that I think is sometimes misunderstood around the sustainability conversation. And that is this nuance between thinking about sustainability topics from a risk reward perspective and thinking about sustainability topics from an impact perspective. And there's certainly a Venn diagram between those categories. But if you think about the benefit to investors on thinking about sustainability is just to acknowledge that the world is changing, that sustainability factors now can have an impact on your portfolio in terms of returns, right? And so if you are in an industry that is now being heavily regulated because it's lost its social license to operate, if you are in an industry that is receiving regulatory subsidy or benefits because there are global goals for climate change mitigation, if you are in a sector that ESG funds are screening, you want to know that there is going to be a certain amount of funds that are not allowed to buy this name anymore, et cetera. And so there's the incorporation of ESG into your process. And that is that there's a lot of debate about language and terms that we think about as ESG integration and thinking about what is the risk on my portfolio from these things. And so what that means is that really pretty much everything we do in active fixed income has that lens on it. And so there might be a company that has a certain amount of ESG risk associated with it, but perhaps the portfolio manager thinks that it is priced into the market. It trades 100 basis points wide because of this risk. We think it's adequately priced, or we think this company, these risks are not going to manifest themselves into the company's bottom line for a number of years. We're comfortable owning their short paper, et cetera. And that's this concept of recognizing risks and asking companies to disclose data on these things. The adage, you master what you measure. And so for us being able to continue to ask for disclosure on things and understand these things and look for data sets around things and understand where is the nexus between risk and sustainability. And so that's one part of the conversation. The other part of the conversation is to think about the impact of your holdings. Right? So not necessarily what's it going to cost me or make me money, but what's the impact of me giving this company money on either the environment or society. Right? And that's where we think about ESG labeled and ESG tilted funds that have screens or set uplifts, et cetera. And that's really thinking about externalities and thinking about, I would say that over a longer term, very long-term investors will think about your externalities will roll back onto your ability to provide returns from a fiduciary perspective over a long term. But that is where we think about tilting ESG funds and how you can affect change in that way. And so they're somewhat related, but the approaches are different. And creating certain tilts on portfolios sit in those ESG tilted portfolios. And so then to go to your question really on the theory of change, that phrase means something. That theory of change is it comes from the impact space, right? And so what are you trying to change with your investments? And I would say that in fixed income, it's a very powerful place to invest when you're thinking about this concept of affecting change. And it's because you're directing capital, right? And so companies come to the market all the time to try to raise capital to run their businesses. And so you have an opportunity as a fixed income investor to have those conversations actively with companies. We don't have the vote. We don't have the same proxy potential that equity holdings have, but we have the ability to have conversations with companies about what they're doing with their capital. And so I think that that's a very powerful place to be. And one of the things that we've been working on is building the market infrastructure around certain asset classes where companies are coming and asking for new capital around use of proceeds bonds. And so for those of you that are not aware of what a green bond is not a bond from a green company necessarily. It's a bond from any company who wants to raise capital for green projects. And so they raise this capital, they take the money, they put it on their balance sheet, it's ring fenced, and they hold you up front the types of projects they're going to invest in, green projects. And so I think it's a really interesting place to think about building market infrastructure on that and then creating scale around that. And so we now in this green bond market, we have sovereigns that issue. We have securitized green bonds, we have corporate green bonds, we have EM green bonds, we have high yield green bonds. And I think, our theory of change on it is then to be able, as an asset manager, our role to create products that will give clients the ability to access this. And so in the dream world, right, in the if you build it, they will come sort of model, we would love to think about the theory of change being that companies are able to raise money for green projects at better rates than they either do currently or they do versus the non-green projects. And so that then rolls back into their balance sheet discussions and the types of things that they want to fund. And so we call that term greenium, their ability to raise green debt at a better level for them than non-green debt. I think of a world where if a company could say raise green bonds at, I don't know, let's say it's 50 basis points through where they can raise non-green, that changes the conversation internally. It changes how they allocate. And so those are very powerful tools that we think about building right now with this market infrastructure.
I speak with a lot of people because of the show, and I'm often asked how buying and selling the bonds on secondary markets drives positive impact. Now, you referred to green bonds, and that's at the issuance stage. Of course, all these bonds are publicly traded. I don't know what percent of your investment are new issuances with the issuer.
Green bonds are green bonds whether you buy them in the new issue market or the secondary market. And so these bonds come to the market and they represent a funding piece that is directly linked to a certain use of proceeds at the company. And when you buy a green bond, these are tagged, if you want to say, in different systems, in whether it's Aladdin or Bloomberg or in the prospectus, they're identifiable. And so I can go to the secondary market and look for a green bond, even if I didn't buy it in the new issue. And you get all sorts of benefits from these as a secondary market buyer as well as a new issue buyer. You get the same reporting, you get the transparency from the issuer. So I'm really indifferent whether I buy it in the new issue market or the secondary market. I think this conversation about direct buying maybe is from a bleed over from more maybe like the direct lending space or the project finance space, rather than the fixed income public markets where you would hope you maybe get a little concession in the new issue market, to step up and stop what you're doing that day to buy this bond. But other than that, you should be pretty indifferent whether you buy something new issue or secondary. The idea when we talk about theory of change, it does transmit through a secondary purchase because companies price all of their new issue off their secondary curve. And so even if I'm not buying the bond in the secondary market, in the primary market, if I've bought in the secondary market, I've tightened their spreads. And so it's to me, I'm indifferent. It would be the same thing as saying if I were to buy in the primary market and then I got to flow into a fund and I needed to top up going to the secondary market, to me, it's still the same impact. It's still the same purchase.
You've referred to the PEXT, the next framework for sustainable fixed income investing. Maybe you can introduce that. And in fact, just this morning at breakfast, I said to my wife, you know what this industry needs? We need more acronyms. So I want you to explain what PEXT next and how you use it to construct your fixed income portfolios across different strategies.
Okay, so what PEXT next stands for? It stands for positive externalities / negative externalities. And what this was born from was, as you accurately point out, is that we are at this point swimming in ESG data. There is so much ESG data coming at us that we have thousands of different key performance indicators, KPIs, there's another acronym for you, that we can look at for companies. And in fixed income, the investments that we make are not just companies. And so if you think about a global ag index, the majority of it is not corporate bonds. It's going to be sovereigns, securitized, supra paper, munis, et cetera. And so when you think about constructing a traditional fixed income portfolio, corporates are only one of the things that you're using as your building block. And so a number of years ago, as we're dealing across all the different teams that we have, it can feel a little bit like people speaking different languages. Some are using this data set, others are using that data set. Portfolio managers are asking, I see all these ESG KPIs, but what am I looking at? Tell me what's good. Just tell me what's good. Tell me what's bad, right? And this is a conversation that we hear globally. Tell me what's good, tell me what's bad. At BlackRock, we run a number of funds that are commingled, and so you're trying to find the Venn diagram of what most clients are going to want. We also run a number of seg mandates, and that's a big part of our business, is people having very bespoke needs of what they want to either include or not include. But if you're in enough of these conversations globally, you do recognize that there's a general consensus about, what people don't want to include in ESG portfolios, and a general consensus of the things that people want to move toward or lean toward. Now, obviously, there's debate among different topics. And so what we sought to create was a framework for portfolio managers to think about a simplified version of this is good, this is positive, and this is negative. And so that's really how it started. And we have 4 different tags that exist on pretty much every holding a fixed income portfolio manager could tag, and this works for equities as well. We have some funds that hold equities. And the tags are positive. The second tag is we called baseline, meaning it's neither here nor there. It's not going to offend anyone in an ESG portfolio, but it's not maybe giving you the best in class positive externalities. Another tag that's called negative, which is the combination of things that we traditionally would screen from an ESG fund. So think about the classic topics like coal mining or UN Global Compact violators. Some of the screens of things that are not allowed in different country labels that we include. And then we have a final category, which is called discussion. And that is where a lot of the active sustainability management will live. Like you mentioned, I'm working on as a portfolio manager on funds. So there could be companies that either we don't have enough data on to make a determination whether they're positive or negative, or they're kind of middle of the road and we need to find out more. And so it's our view at BlackRock that because we have so many big global teams that are bottoms up sector specialists and so many people talking to companies that we want to leave a space for that interpretation and really understanding the company the best. And so those live in discussion. And so the beauty of this framework is that it goes across all the different asset classes. So we have different KPIs for sovereigns. We have different KPIs for munis. We have different KPIs for securitized, for emerging markets. We're looking for the best in class in your particular asset class or sector. And all of that data, the lion's share of this data is coded data. We're looking for specific quantifiable data points that will put you into a certain category. And we feed in all of this data into our Aladdin system. And what is kicked out is this tag. And so for a portfolio manager can look into Aladdin across all the different assets that they have in the portfolio and understand how much of this portfolio is PEXT, how much of this portfolio is Next, how much is DEX, and then where do we need to focus on the DEX names? Where do we need to see if we're engaging or be having discussions on this? So it's really been simplifying. And so we've been super transparent about the rules that roll into PEXT Next. We've published a white paper on this, and we outline every single rule for the asset classes that goes into this categorization. And so this is now what started as sort of a framework for conceptualizing these things is now a tool that we use to create portfolios. And now because this data is in Aladdin, and when I say the data, all the different KPIs are in Aladdin, but also that tag, that PEXT tag is in Aladdin or Next. And so you can do portfolio construction on that tag. You can run risk reward scenarios on that tag. You can use this even if you're not in an ESG flag to say, how many Next names do I own? Why are these Next names? Is this something that I need to have a heightened awareness from? Am I going to be asked on this? Is it potentially, a problem in the portfolio? And so it's become, I think, there's a lot that goes into it, both from methodology and sector participation and coding. But the simplicity of it, I think, really helps to frame where do I start? And so we've been able to use this tag in a number of our portfolios that we run. And the way that it's used really depends on the fund that you have and what you're trying to gain with this fund. So an example of a fund that we use this on is we have a fund called BGF Sustainable Global AL. This is a multi-asset fund. It's a European-based fund. It is an Article 8 fund for those of you that are following SFDR, but it also has all the different country labels that are required. So some of PEXT Next is related to, if this country label screens it, we'll potentially add this to Next. So that you can use PEXT Next to make sure that you're conforming to some of these country labels. And so anyways, for that particular fund, what they can do is they can target a minimum of 50% PEXT in the portfolio and then zero exposure to Next. And so that is the way that his portfolio is run. We'll have other portfolios that will target a combination of the PEXT and the BEXT. Maybe it'll be an 80% target on that. It just depends on what your underlying asset class is, what your alpha targets are for the fund, who your audience is, et cetera. And then within PEXT Next, just to get back to green bonds, obviously a green bond is a PEXT holding. And so PEXT lives both at the issuer level and at the CUSIP level, which is the bond identifier. And so within PEXT, we have subsets of things. Impact Holdings is one of the things that is a subset of PEXT. And so these use of proceeds bonds that we get in the market, these green bonds, these social bonds, those are PEXT names. And we can use the data that we have in Aladdin to create then only impact bond funds. And so we have a couple impact bond funds that we characterize as Article 9 under SFDR. They're pretty much 100%, say, use of proceeds green bonds. We have one that's a global one, and we have one that is also an emerging markets one. And so we'll use that green bond tag in Aladdin to select the securities that go into that portfolio.
What's behind all of these tags? And is that data that you're developing in a proprietary way, or are you feeding in MSCI and all the same data everyone else in the market is, but interpreting it in your own way? At the end of the day, somebody's making these determinations. Where does this data come from, and how is it being ultimately funneled into a tag?
We are looking to use as much quantifiable data as we can for these tags. And a lot of that data does come from third parties. And I can walk you through from some examples of what that looks like. But it won't just be necessarily someone's qualitative rating that's a third party that we're piping in. So for example, we'll look for your percentage of your revenue from coal generation, for example. That's just a data point, right? And we can pipe that through from different ESG providers that collect this data from company reports and clean it up for us and provide it in a clean API. Some of the data that we use will be a rating. Like, for example, we do screen the worst of the worst from the ESG ratings in Next. What we select to go into these categories is really trying to reflect what we see as what clients are looking for on these ESG funds. And so it's a combination. It's not what Ashley and her team think is good for the world. It's really having hundreds and hundreds of conversations globally with clients to understand what would they like to see emphasized. And so, for example, the things that we would emphasize in a positive externality might be something like companies that have made climate commitments. And so a data source that we use on that is something called the Science-Based Targets Initiative, where companies go and they officially publicly set targets, and then they set targets. We can scrape that data. We have that data. We can give them credit for having made that climate commitment, right? We can use your best-in-class ESG leaders. We can use the things like green bonds, social bonds. We can use other data providers like Transition Pathway Initiative. There is some qualitative work that goes into that, but these are publicly available data sets. We're trying to shed as much sunlight as we can on it. Other things will come from different data sources that I wouldn't say they're proprietary, but maybe the methodology is proprietary of what we think about what is best in class in PEXT. And we talk to clients about it, for example, in the mortgage space, right? And so in the mortgage space, there are no third-party data sets that will tell us ESG characteristics of mortgages currently. So what we'll do is we'll come up with in-house methodologies of what do we think could represent the best in class in the mortgage market for sustainability. And so we'll think about pools with a high percentage of loans and things like manufactured housing. Those are energy efficiency of how do we think about the ABS market? For example, we'll tag solar receivables in the ABS market. The spirit of PEXT Next, what we're trying to capture is, what is the best in class in your sector, and really work with the sector teams to understand what could we find in your sector. Some sectors have more than others, right? But let's make sure that everything we tag as PEXT is we have data to support it, and there's a methodology behind it. I mean, all this obviously goes through layers and layers of governance and committee meetings and approvals and then data quality checks. And so, you were looking for some other examples of things that would end up in next. So sensitivity in the U.S. community statement about like lotteries, private prisons, things that are going to be companies that are flagged for deforestation, the typical kinds of things that we don't want to have in an ESG portfolio. And it's a living document, right? And so what we try to do is, and again, the data space in ESG is moving. We get better data sources all the time. We want to make sure that we're using the best-in-class data, anything new that we think is valid. And so we will make changes to PEXT Next over time. We'll include new data sets. We'll tweak it at the margin. The spirit of it is always, to make sure that we're filling client needs, that we're sure that we can use this as frameworks to align with country labels, and that the spirit of it is best-in-class, worst-in-class.
Could you give maybe a brief high-level overview of two of the SRI ESG fixed income funds? I need you to explain ESG-tilted. We're saying that all the time, but I just want to make sure I understand it. A lot of the funds that I've got some information, they're not 100% all ESG necessarily, right? You're creating portfolios, which are big baskets of funds. So just explain how you do that and how much of each fund would be actually ESG and how you get there with the PEXT Next without going down a rabbit hole here.
Yeah. So I think going back to your first question about ESG tilted. So I think I use that term to differentiate between ESG integrated. And again, like language, the language around this is, we can go in circles and talk, what is impact? What is sustainability? What is ESG? But ESG integrated would be, everything we do would be ESG integrated, meaning that we're making sure that we have a lens on the sustainability aspects to the extent that it would affect the risk return of the holding, right? And so ESG tilted would refer really to something that you could have a holding that maybe had the risk was priced in, but at no price were we really interested in funding the activities of this holding. And so it will have constraints on it. It will say minimum of this portfolio has to be 50% PEXT holdings. Hard rule. And that's the way it goes. And if it causes a tracking error to the index, so be it. We say the phrase, this is another thing, we double materiality. So we are seeking to provide financial returns, but we're also seeking to provide a positive externality, if you want to say lower class impact, what have you, or a certain carbon emissions reduction goal, or, a certain amount of green bond percentages, et cetera. And so we're looking to tilt the portfolio in a way so that it has an externality, not just a view on what's the impact on the portfolio. So thinking about, running a portfolio that was 100% PEXT, that's difficult to do when you think about aggregate fixed income portfolios. There are some routes to PEXT for sovereign bonds, one of them being sovereign green bonds for PEXT. But for the lion's share of developed market sovereign debt, those are going to live in BEXT, which are baseline. So imagine running a fixed income fund and you can't trade US Treasuries. That's kind of a hard ask. You're going to have a lot of potentially liquidity challenges, tracking error. Now, that's not to say that we don't have 100% corporate bond funds. Sure we do. And PEXT is it's pretty hard to get to. PEXT is gold star, right? And so we want to make sure that we are, and again, this is not supposed to be, this is the only thing we look at, right? Because we're active. If that was the case, then we'll just make an index, right? A lot of names end up in discussion. And so what's the story? What's the sustainability story of this company? Maybe it does have some, cool revenue. But they're investing heavily in renewables. If it had enough to be in next, then it's a no-go. But there are companies that are very much in transition right now. And I think we want to lean into the companies that they might have, maybe not everything they do is best in class, but they might have strong transition go forwards. And so we really want to try to understand that. And so within discussion, we will discuss that and we'll make determinations on some of those holdings based off that. And so that's really where the active sustainability management comes in. But, a lot of our funds use PEXT Next. Like I mentioned, BGF Sustainable Global AL is a multi-asset fund that uses PEXT Next. One of the first funds to use this was the BGF Sustainable Fixed Income Opportunities Fund. And that doesn't have a stated prospectus PEXT threshold. And that's around 38% in PEXT right now, which sounds low, but it's still much better than this investable universe. Right? That fund is a type of fund that I think is really interesting to think about using a PEXT Next framework because that fund probably has 1,000 holdings. So how do you think about managing these funds from an ESG perspective when you have so many holdings? What are the ways that you can scale it? Another fund that I would highlight, again, would be our Global Bond Impact Fund, which is a global fund that goes cross asset class that only includes green, social, sustainable use of proceeds bonds. And so this is a fund that is Article 9. It has a minimum amount of holdings that are considered under our impact platform. It does have a couple opportunities for it in the mortgage space that are maybe not formally green bonds or social bonds, but are dedicated impact pools in the U.S. mortgage space. And this is, I would say, that on the scale of externalities, the most quote unquote impactful. It's called an impact fund, but it's the most impactful funds that we can run because they are solely focused on trying to replicate global ag type returns with this particular asset class. And so we provide impact reporting on these funds. And that impact reporting is driven by, again, one of the good things that we get out of the green bond space is impact reporting from issuers, which is quantifiable. So they'll say for every $1 million invested, you recycle this many gallons of water, you reduce this many emissions, you save this many hectares of forest, et cetera. And so we can use that kind of reporting that we get from companies, download it, scrub it, aggregate it, again in Aladdin, and then produce impact reports on these funds that will show you for every $1 million invested, this impact was attributed to this investment. And so it really just sort of runs the gamut. Again, we use these methodologies for emerging markets funds. The reason we're able to do that, and I know I'm selling PEXT Next on you hard here, but we spend a lot of time on PEXT Next, is because we have a specific EM methodology in PEXT Next. So we at BlackRock worked very closely with JP Morgan on the launch of their JESG index, which is their ESG version of the MBSEMB. And I think, if you are in the EM space, the MBSEMB, the JP Morgan indices are what most people use. And so if you're going to have a credible EM product, you're going to want to use those indices. And so the methodology that is used in those JESG indices is the methodology that we use for the EM portion of PEXT Next, in addition to other things. But that drives some of the methodology for EMs. And so we can run EM funds off PEXT Next as well.
Is it correct to say that the PEXT Next framework is primarily processing or developing labels based on non-financial criteria?
100%.
So you're doing what I might crudely call traditional financial analysis completely separately.
Correct. And so there is nothing in PEXT Next that's supposed to indicate risk reward. It's not built that way. Now, that being said, we have found, because we were able to run some correlations at times around this, but that is not the raison d'etre of PEXT Next. PEXT Next is built to showcase the externalities of a holding, regardless of there's no pricing information that is fed into PEXT Next. It is a tool that we use to try to capture that part of that investment. And then the portfolio management team uses all its traditional financial tools at their disposal to then manage around that. People ask me all the time, we'll have a green bond come to market, and my team evaluates pretty much every single green bond that we look at, that we invest in. And we provide a shading. So we have a methodology where we do dark green, medium green, light green. We have a whole methodology document, a taxonomy around this. And so we do a due diligence of every green bond that comes to market, and we provide a shade on it. And that, again, sits in our Aladdin system: dark green, medium green, light green. And just because we shade something dark green doesn't mean that we're necessarily going to buy it. Like, it can be dark green, but it's expensive, or the sector analyst doesn't like the sector at this time, or, we don't want to be that long in duration, et cetera. So all of those conversations have a part in the portfolio construction.
What are you generally benchmarking against in terms of performance?
So we like to generally benchmark versus the traditional benchmarks. And then that is because, number one, that's some feedback that we get from most clients. They are used to looking at this benchmark. They have history on it. They have a lot of other investments that are on this benchmark, and it makes it a cleaner comparison. And so we'll use traditional global ag, US ag, investment grade corporate benchmarks, even for our ESG funds.
Do you believe that active management of ESG risk in the long run outperforms the market?
So again, we're getting back to the difference between the impact and the risk. And so the answer to your question is yes, of course. Like, it's just being a smart investor nowadays, right? So if you are a credit research analyst, you are, of course, in addition to all the other things that you're looking at, looking to see whether there are certain ESG risks that you are now aware of, because we have better data sets and better ways to evaluate these things for your holdings. And I think that, as society changes and this concept of intangibles becomes more and more important to companies' bottom lines, reputation, brand, those are important things that drive financials. And so I think that's a big part of understanding, what the profitability of companies is. It's less connected, perhaps, in the sovereign space currently. It's probably harder to make that connection in terms of a country's sustainability profile and its impact on its CDS spreads. You do have a number of ESG reports that will make that link. A lot of them are driven by a couple factors, one of them being willingness to pay, a governance factor, which is like, do you have the money to pay this? Which I don't know if that's really, we think an externality ESG factor. But certainly for companies, I think there's a heightened awareness of these risks.
You served on the executive committee of Green Bond Principles. Could you tell me about that initiative, and then where green bonds, and I'm going to throw in social bonds as well, where they fit in at BlackRock?
I hope one day someone will do, like a Harvard Business School case study on the birth of the green bond market, because it's really fascinating. And I feel so blessed to have, I would say, somewhat witnessed this. And so the concept of a green bond, going back in like 2013, 2014, there had been a handful of examples that had been done by supranational borrowers. But really, it was at that time when the market came together collectively and started to think about sketching out a paper that was published in the FT of principles around a green bond. What could we build? This was a group of individuals, many of whom are still involved in the green bond market, that included investment banks, a couple of bulge bracket investment banks, a couple, I think, Scandi-focused investment banks, a handful of investors, and a handful of issuers. And now this group, fast forward 10 years later, is governed under the International Capital Markets Association, has 30 members on the executive committee, has a steering co, has a observer group, is now a whole infrastructure that contributes to all sorts of topics around sustainable finance, and it has grown. And at the time, we were only starting on green bonds. And so, but really what happened is that after hours and hours of parsing language, debates over words, a document was produced called the Green Bond Principles. And that was the document. And it laid out the 4 things that you should have if you're going to issue something called a green bond. And these are still true today. The ring fencing, the upfront evaluation and selection criteria, the reporting, understanding the transparency around this, et cetera. And that has formed the basis of then moving that into this concept of social bonds, which is same framework, just for social projects. And now something called sustainability bonds, which is a combination of projects that would have otherwise been included in green or social bonds. The group now has published guidelines on sustainability linked bonds as well. So I think this was really important to have this coordination across all the different players in the market to get together and agree on this topic. And BlackRock partnered early with a client. This is public. Zurich Insurance gave us a $1 billion bond mandate to buy green bonds. And so I think that, we were willing to lean into this theme. Zurich was willing to lean into this thing. There were some investment banks that were starting to talk to their issuers about it. And what has emerged from this is nothing less than remarkable. I mean, people, we've criticism of this green bond or that, but you think about what has been built here. This is now $1 trillion asset class. It's an asset class that came out of nowhere. It was created by private markets. And now I would say private with that, we had the World Bank support and EIB and EBRD, those were a big part of it. It's not totally private, that word, but it was really a private markets, capital markets invention that worked. And it worked for a couple of reasons. It worked because, again, transparency. We know what we're investing in. We don't have to look under the hood too much. We have it right there in the documents. And the fact that we were able to invest in something that was already digestible to investors. And what I mean by that is when you think about an asset owner wanting to have a positive impact or wanting to steer some of its capital to positive externalities, the way that asset allocation works, I think it's a slow process, but it's obviously based on an evaluation of where is my fiduciary responsibility and where do I want to asset allocate here. And that's done at a very broad level. It's X% equities, X% fixed income, maybe some bucket in alts. And you're not going to see overnight investors move from a 5% allocation in an infrastructure fund, say they want to go to renewable infrastructure, to that being the lion's share of their portfolio. So you really have to feed them where they live. And fixed income allocations are a core part of many global investors' book. And so when you think about a green bond, this is a bond that the credit risk of this bond is the same as the parent, is the same as the non-green. So you don't have to do any extra credit risk. You're getting this impact with something that they're used to investing in, has the same liquidity, the same CUSIP, the same deal size often, something that is going to be in indices. It's something that they already know how to trade and already know how to invest in. And so the transparency and the ease of investing in, I think, is what has made it so successful. And then we just continue to get more now support from either bigger, important issuers, but also, I would say, regulatory support for the asset class. I'm sure you've seen the EU Green Bond label that is coming. We see different support regimes globally from different countries about whether it's support for third-party opinion providers or maybe a haircut at the central bank on lending if you've issued green bonds, et cetera. And so we're starting to enter this conversation when there's a lot of asks about the public-private partnership for climate finance. Where is the nexus? How can public money support private capital? Well, here we go. We have a private capital, we have a market, we have an infrastructure, and this is a place where maybe we can meet. And that was really I think, 10 years ago, did we dream that we could be at this place? I think we would all have been, the issuance is down this year. Green bonds are lower. The fact that we've created what we've created, and it's still, I think, going to grow. We're going to get more greenium, and I hope and expect that we'll get more support. It's just been a fascinating time. For someone who's been involved in fixed income for as long as I have, this was an amazing accomplishment. And it really came out of a lot of collaboration on the different players.
I spoke sometime back with Brown Boss, who developed the NNIP green bond business. I think he's since moved on to Goldman Sachs, but he told me that they don't invest in green bonds for nuclear energy.
We, for the most part, like to get consensus on projects that can be controversial. And we get a lot of feedback from clients on this globally. Again, it's not necessarily on some of these things. They're sensitive topics. For some period of time, we did not include nuclear in green bonds. And that is not because we didn't think that it was climate friendly, but because it was controversial. And we just said to issuers, you know what, just leave it out of your green bond programs. Since then, we are including nuclear in our green bond tagging. There are different layers of whether you're supporting existing nuclear projects. It also, for some time, wasn't something that came up very much because building new nuclear is not happening, right? It's too expensive. We're not seeing these projects. So the support for existing nuclear, we think it's an important part of climate mitigation. We're excited and hopeful about some of the new technologies that we're going to see come out of the nuclear space that may have a little bit less worry about some of what we say, the do no significant harm downsides on the environmental impacts.
Backing away from exclusively green bonds, but overall your fixed income portfolios, how do you measure that impact piece and report it?
There's the very pure way to answer your question, which is, and again, that word impact, that means something at BlackRock, right? We have an impact platform. To have impact in a name on a fund, you have to go through a whole different approval committee. You have to be aligned with the IFC impact principles. You have to be audited on this. You have to be able to report on impact. And so on our impact funds, we do report specific impact metrics. And the purest way to do this is to, for example, I'll give an example. One of the things that we like about green bonds is that you get this impact reporting from the issuer. So I'm not going to tell you, Scott, that we go and I'm like measuring the water capacity of these different projects, wherever that we have to rely on the issuers to provide it. But we get most issuers in our portfolios providing this. The metric that we see the most is emissions avoided, because a lot of the projects in green bonds are around energy efficiency and renewable energy. And so they can provide emissions avoided. And so we collect that from issuers. It is a very arduous process. It takes a couple members of the team a couple months to collect all this, because you have to go one by one and get all these, and we get more and more green bonds and more issuers. This year, we did experiment with checking our work using an LLM model, which was fascinating because I have a number of coders on my team, and I thought, there's no way this will work. And we built it, and it was amazing. It caught a lot of topics for us to dive into. And so we're looking forward to a time when this isn't so manual. But at this particular time, it's done manually. And so that, in my mind, when you say, what does an impact report look like? That is an impact report. That is the actual metrics. Now, measuring the impact, lowercase impact, that can mean a lot of things, right? And so across all of our funds, not just our ESG funds, we provide, and this is, I think, one of the beauties of Aladdin is that we have the ability to do this. We provide things like how much of your portfolio has set science-based targets. How much of your portfolio is in green bonds? How much of your portfolio is aligned to certain ESG scores? How much of your portfolio, what is what they say, the implied temperature rise, the ITR, this new metric? We can provide lots of different metrics on the portfolio that will measure the sustainability characteristics. And how you view impact on that is just a reflection of, which of those metrics are the most important to you. So if you're more interested in social impact, we'll have social impact metrics, climate impact, et cetera.
On a similar line of thinking, let's discuss issuer engagement for a few moments. What is your approach to direct engagement with corporates in your fixed income investing activities?
I think that's a really important part of active management. And I think that clients are more and more expecting to get more color from their asset managers about these activities. And so the engagement with corporates is done in a number of places at BlackRock. It is done by our BlackRock investment stewardship team as a general part of what they do. And they engage on behalf of all investors at BlackRock. But it's also done with the different portfolio teams, and it can be portfolio specific. And so, as I mentioned before, a lot of the focus on our engagement will live for DEX names that we want to include in ESG portfolios that maybe we don't have enough data on. It could be even high yield names that are covered by nobody. And so we need to find a way to PEXT next these manually. And so that requires talking directly to the company, understanding what their business model is, understanding what their sustainability objectives are, et cetera. And so that is done as a part of the fixed income group, as well as the broader BlackRock effort. And some of the engagement that we can do, which I think is impactful, is especially in the green bond space, in the capital markets activity. So, engagement and conversations with companies, some of these sustainability topics, they take a long time to play out, right? So these are multi-year issues for a number of these companies. They're on long journeys around this. But when we think about this capital markets activity that we're seeing, the issuance of green bonds, again, going back to this, we have a lot of interaction with companies that want to know, what are you looking for? What would be, tell us about your shading. What would this program get in your shading? If we come to this, are we going to get booed by the investor community? How do you think about these topics? And so we spend a lot of time in my team engaging in the capital market space with issuers to help them shape some of these programs. And so, I know you would be interested in an example. I think this week we had an example of a U.S. chemical company, and they came to market with a green bond. And we met this company several times. The green bond of a chemical company in a hard to abate sector is going to be one that is going to receive a lot of scrutiny, right? Because these are highly emitting businesses. And so we met lots with this company. We gave them feedback. We asked them for some certain thresholds to be put in their program. And through that engagement, I'm not saying it's just because of BlackRock. They probably heard this from other investors as well, but they added those. They added those to this. And then when they came to market, we were able to shade them and include them in our green bond funds and invest in that holding. And so when I think about the impact that we can have in engagement, that's really where I can touch it, right? I can see, what was I able to shape through this conversation? How was I able to help this issuer? And oftentimes it's a help for us because we get better bonds and we get a holding in a company that we wanted to buy in an impact fund, but maybe we couldn't because it wasn't agreement. We get a good holding, but we also want to help shape the market. And then going back to your question about theory of change, I think we do see that as something that we help do, is to help create standards in the market and help use our access to some of these issuers to share what we think is best in class.
What does competitive advantage look like to you in sustainable and ESG fixed income investing in the public debt market?
So I would say, from my vantage point, what I see that we're able to capture is having, number one, I would say deep sector expertise and the ability to be very detailed in the different bonds that you're looking at across different sectors. And so I think that's important. Global sector teams, especially for sectors where we don't have ESG data currently, which are a number of sectors in fixed income. And for the sectors that you do have ESG data, I think being able to have access to all that data, right? To be able to purchase it, pipe it, use it, put it in a system, be able to dissect it, that's important. And then so that is related to, I think, some sort of underlying infrastructure like in Aladdin that allows you to manage these big data sets in an efficient way. And so it doesn't eat up 100% of your day. It allows you to take a look at, well, if I put this screen on, or if I did this tilt, what would it do to my returns? It's a constant conversation we have with clients. If they, what is the sensitivity to tracking error on some of these different ESG tilts, and be able to understand that, I think is important. I think, like we talked about, engagement's important. I think you need to have the teams to do that. You need to have the access to be able to do that. I think that's important. And then I would just say, I think for big asset managers like BlackRock to be able to provide these products in an affordable way. And so, not have funds that are the greenest of the green and they have all this, amazing expertise on them, whatever, but it costs you 100 basis points to invest in them, right? And so, I think we are, one of our competitive advantages that we're able to democratize this and give access to some of these in the way that we scale. So, I obviously preaching my book here, but obviously, BlackRock, we do have these competitive advantages. And I think that does help us when we try to run ESG portfolios.
Was there anything that we buzzed around the edges on that you would like to either go back to, or anything in particular you would like to speak about in a little more depth than what we were able to accomplish so far?
The only thing that I would add is that I think that we are trying to be really transparent about our activities around engagement, especially around voting. And we're publishing lots of what we call vote bulletins at the firm that will outline what things did we support, what did we not, why, what are the things that we're engaging on, because there are a lot of questions around, what kind of conversations we're having with companies. And so there's a real effort to be transparent about that and to be able to report on that.
If someone wants to get into the sustainable ESG fixed income space, how would you advise them to get into the business, and what's the best place for them to cut their teeth?
I am blessed to be in a sector that is attracting a lot of young people, and it makes me hopeful for the future, but I do get this question a lot. And my advice to people is that if you are interested in being in fixed income, you need to learn fixed income. You need to learn this asset class. And then you can be, a professional. But if you're looking to get information on green, I would say that, number one, there are a lot of academic programs now on sustainability. Probably every college now has some kind of master's in sustainable finance program that you can participate in. That did not exist a handful of years ago, so that's a growth. I would look at listen to podcasts like yours. Look at some of the blogs like Environmental Finance, Responsible Investor, FT Moral Money. I think Bloomberg New Energy Finance does great research. Start to read some of these blogs that are, available to you. Start to learn more about climate science. And the way that you could start on that would be to follow some of these well-known climatologists. There's something in the industry we call climate Twitter. I don't think you call it Twitter anymore, whatever, it's called X now, but whatever. Now we've all moved to Threads, right? But follow these famous climatologists. They tweet, they put out stuff. So Michael Mann is one of them. Glenn Peters is another one of them. Look for these. And once you get clicked onto one of these, then the algos will send you similar stuff. And so you can kind of read in snippets and get a sense of what's going on there. And then I would just say, when I'm, a lot of ESG work is data, and we're swimming in mountains of data, and we are looking at how we can use AI and LLM models to make this similar. So learn to code, be as technically savvy as you can if you want to get into finance in general.
Ashley, you've been very generous with your time. I think we've amazingly gotten to the finish line. I've really enjoyed it. It was really great talking with you. And so I want to thank you very much for taking me through all this. I really appreciate it. I've learned a lot. Tell everybody about your websites and social media and all that good stuff.
Well, sure. You can follow us. We are on LinkedIn, on Twitter, on BlackRock.com. We publish lots of interesting papers around ESG and other topics. And, hopefully that's easy to find.
And what's the best way for people to contact you?
The easiest way is through LinkedIn. I'm Ashley Schulten, and I'm on LinkedIn.
Ashley, thanks again for speaking with me on this. And I look forward to getting deeper in the conversation on this some other time.
Great. Thanks for the opportunity, Scott.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.